afternoon or good evening, everybody, wherever you are on this planet. Welcome at this webinar of the Global Sustainable Investment Alliance, or GSIA. We have 1 hour to talk about the global trends in responsible investment with speakers from Europe, François Passant, he's the Executive Director of EuroCIF, and from the US we have Meg Voorhes of USCIF, and both will share us their reports they made on the trend reports on SR trends in the regions. Before we do so, perhaps just a couple of words about the Global Sustainable Investment Alliance. It may not be familiar to everybody. Basically, it's like the name is saying, an alliance, a coalition of CIFs around the world. And a CIF is a Sustainable Investment Forum, often a multi-stakeholder organization aimed at creating a sustainable capital markets, or to say it differently, address sustainability in and through the capital markets. They are mostly local and regional and national based, and that makes sense because that is where we have the players, that is where you have the certain regulation, and that is where you have the certain business culture. So that's where you meet and come up with new ideas, new initiatives to enhance sustainable and responsible investment. Now, if we can return to the last slide, the previous slide, I mean, where you can see the participants of this Global Sustainable Investment Alliance. That is EuroCIF for Europe, but EuroCIF itself is an organization of 9 national CIFs. In most of the large companies in Europe, you have sustainable investment forums, and further down the line you see that 2 of them, UCCIF in the UK and the VBDO in the Netherlands, also participate directly in GSIA, being 2 of the largest European organization. And then there's SRIA based in Hong Kong, that covers the Asian region, and BRIA, that does the same thing for Australia and New Zealand. Both of them were in a webinar this morning presenting what's happening in their areas. And of course we have USCIF, and we are very happy to have them on board in this session, as they were all sleeping this morning. What's the mission of the GSIA? Basically, of course, like I said, to address sustainability to the capital markets, make sure they help in the transition of the economy, and more practical, to deepen the impact and the visibility of the CIFs on a global level. Of course, the idea is that we finally have a world where sustainable investment and sustainable and responsible in our minds is an investment where you take environmental, social and governance elements into account, but also it's a way of long-term investing and looking at the real economy. By doing so, you find real solutions for the real challenges we are facing. Now, since many years there are SRI reports in a lot of the regions. EuroCIF launches one every 2 years, USCIF does every 2 years, and also some of the other regions. And we thought of combining those reports in a global overview. Now, this webinar will mostly be about the reports in Europe and in the US. But you have to be aware that there is something like a combined and aggregated report that looks to the high level on a global scale. This is the second time we did this. You see it on a picture, and you can access it to the link you see below. But it's also to be found, of course, on the website of the GSIA. Now, to give you some of the highlights in a second. Let's go to the next slide. But first, we look to the instructions for this webinar. We'll have the 2 presentations. After I start off with a couple of 2 or 3 slides on the global report, we'll have the 2 presentations for Europe and for the United States. Please send in your questions. If you look at the text box to the right of your screen, you see there are questions, and you can just ask questions all through the webinar. Please address the person to who you want to ask the question, or mention this person, or perhaps you want to ask a more generic question. That's also fine. At the end, after the presentations, we'll have time to address some of the questions, and of course, to make it as interactive as possible, we encourage you to ask your questions all through the webinar so you don't forget them. And finally, for your information, this whole webinar is recorded and it will be available on our website, and I understood also on YouTube channel. So that's about the webinar. The program has been mentioned. So let's go quickly to the slides of the global report that has been made and can be found on the site. First of all, the good news. The global sustainable investment market has continued to grow, and in a quite substantial way. It has increased from 13 trillion to 21 trillion in 2 years' time, and that is a huge growth on an annual basis. It also covers now about 30% of the professionally managed assets in the regions that are covered. And mind you, not all regions are covered because we missed in the report Africa and South America. So that is pretty substantial, and this 30% I have to indicate that of course includes the most light form of what we would call responsible investment. So if you look at the various strategies to do so, you see them here on this slide. The largest strategy that has been used and also has been growing extensively is negative or exclusionary screening. And as will be pointed out also later on in the webinar, this includes only voluntary screening. So let's say above what legislation requires. To give you a clear example, in this country, in the Netherlands, we have now legislation in force forbidding investments in anyone who produces, distributes, or sells cluster ammunition. And 2 years ago we did not have that legislation, and we would add all those investments having this exclusion in this category. But after legislation came into force, then we deducted it again, because now it's just a matter of getting into the following legislation, which of course is expected from all of us. The thing is that the 30%, let's say, of the total market that is now let's say invested responsibly and sustainably starts with the lightest thing, which usually is an exclusion on, let's say, cluster ammunition, for instance, or controversial weapons. So that is, let's say, what we call responsibility light. But the 30% isn't 30%. In some areas that number is a lot higher, like here in Europe, which François can tell more about that. If you look to the strategies that are mentioned here, there's a lot of data on one slide. What you see is a couple of things. First of all, besides negative screening, you see integration. ESG integration, the fact that you include ESG indicators in your portfolio selection is a very popular one. It's now the second largest, but also the growth is tremendously. It's grown 2.5 times in those 2 years' time. Also, you hear more about this ESG integration. How do we vision it in the presentations you will hear later on. Another thing where I'm happy to see is corporate engagement and shareholder action. A very simple, you could say, but very effective means, because after all, then you influence the companies you invest in, and the solutions, the answers for the challenges we face in the level of food, energy, water, raw materials, they have to provide solutions for that. So it's a very effective way to make your money work for you in the right sense, and you see that that also has grown a lot substantially, let's say, in the last 2 years. Also one of the best used strategies at this moment in time. For the first time, both presenters will tell you a bit about impact investing. That was something that came up that we didn't talk about a lot in 2012 in our report, but it has come up. There's a lot of discussion, debate about what is the right definition, but we took it into the report, and you see, though it's of course tiny compared to the big numbers, it still is getting more and more popular. So with that, I would leave my comments on the global report, and again, let's listen to our speakers as they go in detail on their regional report. So 2 speakers. First we start with Eurociv, that will be followed by a speaker from US Civ on their regional reports. François, can I give you the floor?
Sure, thank you Giuseppe, and welcome to everybody to this, let's say, first Global GSIA webinar. So what I'm going to do with you today is review findings of our latest European SRM market study, which was published last October, based on data reported as of the end of 2013. And this was the 6th edition of that kind, so no need to say that we have a long track record in doing this kind of study. We're surveying 13 EU markets, so that's always a challenge to brush, the portrait of the European market. It's a very diverse market. In fact, it's not an harmonized market, I would say. There are, depending on where you are, different sensitivities, history, culture that influence the way SRI is defined, SRI is implemented in practice. And there is no universal definition of SRI around Europe at this stage, even though there are attempts to be better at defining what this means. But so what we've done in the study is we are covering 7 processes that we believe are part of the ESG family, which basically broadly defined would be any approach taking into account both the financial objectives of the investor as well as his or her concerns for ESG matters. So the numbers that I will comment are based on an extensive survey of the industry. It's self-reported. On the one side, we survey asset managers, and on the other side, we survey asset owners for the part of their assets that they still managed internally. So we try to avoid any duplication here. And just a few also elements of information before I deep dive into the numbers. I would like to draw your attention between the different types of strategies. On the one hand, there are what we call here at EuroCV the overlay strategies, and I refer here to exclusions, ESG integration, norms-based to some extent, and even engagement and voting. These are typically strategies or approaches that can be deployed on a very wide range of assets through a policy. So for instance, if you are a 500 billion asset manager, exclusion policy covering your entire asset range, and that policy specify that you need to exclude controversial weapons, for example, we would include 500 billion under exclusion, which also explains why some of the strategies boast some huge number, so you have to understand what's behind that. And on the other side, you have maybe more product-specific strategies like sustainability-themed or best-in-class, best-in-universe, best-in-effort approaches, which are much more difficult, of course, by definition, to deploy on a wider range of assets through policy. They are really associated to specific products. So the volumes of assets are, of course, not directly comparable. And you have to keep this in mind. Maybe we can okay, I've got already the slide. So when we take a snapshot of the European market as a whole, what you see is that exclusions have somewhat gone mainstream. And we measure by exclusion. I should also specify that we only measure voluntary exclusion. So we exclude these exclusions that are mandated by law. Let's take an example. For example, in Belgium, in France, or in the Netherlands, you are mandated by law or prohibited by law to invest in cluster munition. So any investor in those markets that would have an exclusion policy on cluster munition would not be, the asset would not be counted under exclusions, to make that clear. So we are only talking about voluntary exclusions. That represents about 7 trillion euros in assets. That's about 40% of the entire asset management market in Europe. So clearly exclusions have almost gone mainstream there. So most popular and consistently applied strategy across the EU. It is present in virtually every European market to a large degree. And typical criteria would include controversial weapons, tobacco, alcohol, gambling, and nuclear weapons. These are the most typical exclusion criteria. Now, the second most popular strategy, as you can see, is ESG integration with about 5 trillion euros in assets. But here I shall also specify, and I'll come back to that later, I've got a specific slide on this, that we record all types of integration. Remember, this is self-reported data. We have a very specific definition of ESG integration, but we cannot always control what people report. So in the broader sense, we have in Europe 5 trillion of ESG integration as it stands today, but I will detail what's behind this high number later on. In any case, it signals that this strategy is also gaining a lot of traction here in Europe. And third, norms-based screening, which I believe is also a kind of a European phenomenon, is a third most popular strategy, even though it's not present in all markets to the same extent. It is mainly a strategy that emanates from the Nordics a couple of years ago, and that has now percolated to other markets. I will also come back to that. And I think if I refer to the slide that Giuseppe presented, Europe represents over half of the norms-based assets worldwide. So it's kind of a European phenomenon to some degree. And then engagement and voting, which has also increased very significantly over the past years, is a very popular strategy. This has been mainly driven by the apparition of stewardship codes and the growing recognition that being a steward, being accountable to your beneficiaries and clients for how you manage your assets is gaining also a lot of traction. In terms, best in class is smaller, but it's interesting. It's also a pretty concentrated market. In fact, France represents more than two-thirds of the, or more than half of the European best-in-class assets. But there are signals also that it is a strategy that's gaining traction in other territories, such as Sweden, Norway. It's also quite popular in the Netherlands and Switzerland to some degree. So we can move now, after the snapshot, we would like to have a look at the growth between 2011 to 2013. And no wonder the impact investing approach is the strongest growth approach. I mean, albeit from a very small base. We started to measure impact investing back in 2012. So we now have a first growth number. Impact investing, and I didn't show this in the previous slide, is about 20 billion euros. So for the sake of scale, we didn't represent that in the previous slide. But growth is here. As you can see, it's a vibrant market, but a tiny approach compared to the other SRI approach. But then it's also interesting to look at the other overlay approach, from ESG integration to exclusions, and you can see very strong growth there for all those four strategies, even though the starting base in terms of assets was already pretty big. And it's very encouraging again to see that engagement and voting is growing very fast. More and more asset managers in particular, but also asset owners, are adopting engagement and voting policies for the equity part of their assets. And on a positive note as well, the positive screening strategies, I said, best in class and sustainability themed, even though they are smaller in assets, they are also growing to a large extent. The good thing is that all strategies have outgrown, in a way, the broader asset management market in Europe. So the total growth, the average growth of the professionally managed asset management market in Europe was 22% during the period, and as you can see, all our SRI strategies have outgrown that number, which is very encouraging. So we can move to the next slide, and now a couple of zoom on specific strategies, starting with norms-based, which I thought could be interesting because, again, I see this as a, at least for a large part, as a European phenomenon. So as I said, it originates from the Nordics, and the Nordics are still a very large contributor in terms of assets. We started to measure this in 2010, so it's not an old strategy, but it has been a fast-growing strategy. The most common screens are the UN Global Compact, and to a lesser extent the OECD guidelines. For us, also just a precision, for assets to be recorded in our study under norms-based, the norm that you have to screen or comply with has to cover E, so environmental, social, and governance criteria. It's not one or the other. We believe if you cover only one dimension, then you're more related to exclusion. So the UN Global Compact or the OECD guidelines are also multidimensional, if you see what I mean. So it's now spreading outside of the Nordics. France, interestingly enough, has become the largest market due to the adoption of this strategy by a couple of very large players in that market. It accounts for about 1 trillion in assets under norms-based. But the Netherlands is also a pretty big market with 700 billion euros, as well as Sweden and Norway, of course, by definition, being Nordic markets. But we see growth pretty much everywhere for this strategy in Spain, Switzerland, Austria, some of the smaller markets. So I believe it is typically one of the strategies that has the potential, just like exclusion, to become very widespread all across Europe, and maybe contributing to, let's say, a convergence of the market. Okay, next strategy we want to look at is ESG integration. And I will go back to the definition of ESG integration. So we have defined ESG integration as the explicit inclusion of ESG risk and opportunities into traditional financial analysis and investment decisions based on a systematic process. So it has to be explicit and systematic. This definition, by the way, is also the GSIA definition, and I believe it's also a definition that the PRI have adopted. As you see, if you look at the definition in all the reports, there's a very strong alignment of terminology between our respective organizations, which is also, I think, one of the contributions that the CIFs and GSIA can do, trying to harmonize a little bit the terminology that is used around the world. So having said this, you know, and because the data is self-reported, we have tried in the last study and for the first time to break down a little bit the different practices. And one of the questions we had was trying to ask respondents to classify the type of integration they are practicing. We have created 3 categories of integration. The first category is what we call non-systematic integration, meaning it's just about, you know, having ESG research available somewhere on the server to your mainstream portfolio management teams. Category 2, you're already starting to be a bit more systematic about this. We're talking here about systematic consideration or inclusion of ESG ratings, ESG factors into financial valuation. So there's a bit more of a structured process here, more structured interactions between the SRI or the ESG research team and the rest of the firm. And category 3 is really about putting in place some mandatory constraints on mainstream portfolio managers when they are building and constructing their portfolios in terms of using or considering ESG research findings or ESG ratings. And that typically can result in, for example, exclusion of specific securities, like in a red light approach, or overweighting, underweighting of some of the securities. So we've done that, and the result is that about 2 trillion of assets qualify under category 2 and category 3, meaning, you know, this kind of systematic or mandatory approach. And going forward, we've decided at EuroCIF that this is what we would call ESG integration. Sorry, can you go backward, Imre? No, previous slide, yeah. So that's why you have 2 numbers here, 5 trillion, which relates to all categories of integration, and 2 trillion for the more specific systematic integration practices. ESG integration, however, if we relate to the first number, to keep, you know, some historical depth, it has grown by about 40% per annum since 2002, and 65% between 2011 and 2013. So a very consistent growth over the past 10 or 12 years. But most of the market for ESG integration is still concentrated, still gravitating around the French and the UK market. Even though there is growth virtually everywhere in Europe, especially in the Nordics, most of the assets for integration are really concentrated around France and the UK. So, but that's a very positive story, I would say here, and definitely a key trend in the market. As you can see, systematic ESG integration today covers about 10% of the European professionally managed AUM. we will see in the next study to be published next year if that percentage increase. Okay, a zoom on impact investing to finish. As I said, we started to measure impact investing in 2012, so based on 2011 data. You can see spectacular growth, 132%, but from a small base, of course. What we do here, and that might be different to what some other market observers are doing, is we are not accounting for any public or philanthropic funding. So we survey only, let's say, private investors, be they asset owners, be they asset managers, to basically count the assets they are investing in impact investing. And we use a very broad definition at this stage of impact investing. We use the Global Impact Investment Network definition, which is, I'm not sure it's quite satisfactory, but it's probably the best thing we have today. You have to know also that in Europe there are different approaches, different definitions about what is impact investing. Broadly speaking, in terms of sensitivities, you have a sort of Anglo-Saxon approach or definition, which is very close to the GIN definition I just mentioned. Whereas on the continent, there is a tendency to consider that you cannot offer market rate level financial return if you are an impact investor. There is a tendency to believe, again, I'm generalizing, but that if you are an impact investor, you have to give up some of your financial return to the benefit of social or environmental return, which may not be the case in other parts of the world as well. Nevertheless, you also have a breakdown of the impact investing assets in Europe by country, with some surprising elements. So, for example, in theory, the United Kingdom should be on top of the ranking, which would probably be true if we were including public and philanthropic funding. But at this stage, at least, with the data that we have, which again is not perfect, but it's good, we think directionally a good proxy for the market, is not the case. In fact, according to our approach, the Netherlands and Switzerland top the rankings. In the Netherlands, this is the effect of a couple of very large pension funds having invested in some impact investment vehicles or mandates. And in Switzerland, it's probably due to the strong high net worth individual and family office market there, because there is a natural tendency for this sector of the retail market to consider impact investment. It's a complement basically to their philanthropic activity, and so that might explain why those markets are strong there. But it's interesting also to see that it's strong in Italy and in Germany, Sweden. So that's at least the first breakdown we were able to produce on that market. And on that note, I think I will give the floor to Meg to comment on the US market. And I hope there will be many follow-up questions. Thank you.
Thank you, Francois. And thank you, everyone, for joining the webinar. And good morning, good afternoon, or good evening, depending on where you are. So I'm happy to talk about sustainable investing in the United States, which took a significant leap forward from the start of 2012 to the start of 2014. For a decade or so leading up to 2012, sustainable, responsible, and impact investing, what I'll call SRI, accounted for a fairly consistent 10 to 12% share of the overall market of professionally managed assets in the United States. And that changed in 2014 when we at the USIP Foundation conducted our survey for our report on U.S. sustainable, responsible, and impact investing trends in 2014. We found 480 institutional investors, institutional asset owners, 308 money managers, and hundreds of community investing institutions that apply E, S, or G criteria in their investment analysis and portfolio selection. And together, these hundreds of investors accounted for $6.2 trillion in U.S. domiciled assets as of January 1st, 2014. We also found 202 institutional investors or money managers that filed shareholder resolutions on ESG issues, and they collectively held about $1.7 trillion in U.S. domiciled assets at the start of 2014. So there's substantial overlap between the $6.2 trillion in assets involved in ESG incorporation and the $1.7 trillion in assets involved in filing shareholder resolutions. So after we eliminate the double counting for assets involved in both strategies and also for double counting for assets held by money managers on behalf of institutional investors, our total U.S. SRI assets were $6.7 trillion, as you can see in the bottom row of this table. And that is a 76% increase over the $3.74 trillion we identified in SRI assets at the outset of 2012. So as a result, in the beginning of 2014, nearly 18% of all investment assets under professional management in the United States were held by individuals, institutions, or money managers that consider ESG issues in selecting investments across a range of asset classes, or that file shareholder resolutions on ESG issues at publicly traded companies. So the market share, if you will, went from about 12% in 2012 to nearly 18% in 2014. Can we see the next slide, please? Or can I advance it? I can advance it, thank you. This growth in SRI investing is largely driven by demand from a range of retail and institutional investors. Indeed, of the 119 money managers who responded to a question on why they offer ESG or SRI products, the top factor that was cited by 80% of them was client demand. And more than 70% of the money managers responding to this question also said they considered ESG factors in order to fulfill their mission or their clients, to improve returns, and to manage risk. We also asked this question of institutional asset owners. 91 institutions responded. So I've culled the responses that were cited by more than 50%. 78% of the respondents, institutional respondents, said that they practice ESG or SRI to help fulfill their mission, and 73% said they wanted to generate social benefit to have a broader impact on society. So I'm just going to go back to the previous slide for a moment. Thank you. Of the money managers that responded to an information request about their ESG, what types of ESG incorporation strategies they practiced, more than half reported that they use negative screening within their funds, and negative screening has been a dominant feature for many years of SRI investing in the United States. In addition, we have a number of money managers reported using positive screening, impact investing, and sustainability-themed investing. But the ESG incorporation strategy that affected the highest number of, highest volume of assets this time around, $4.74 trillion, in fact, was ESG integration. And that really just, took a leap forward. We're just seeing that, grow by that's almost a fourfold increase in the money managers, the assets of money managers practicing ESG. About this comparison between 2012 and 2014 is that in 2012 we did not ask in our survey about sustainability-themed investing, and that may explain why we're seeing maybe a bit of a decline in the positive best-in-class screening, that people might have chosen that because they didn't have the sustainability-themed option. And I'm also wondering if more investors are now describing what they're doing as ESG integration rather than positive screening. Something to consider. All right, if we can advance again. And yes, great, thank you. On this slide, we see the types of investment vehicles that are domiciled in the United States that are considering ESG factors, so practicing the various types of ESG incorporation. In this table, for instance, if you look at the first two rows, you can see that in 2014, the number of mutual funds, including the mutual funds underlying variable annuities, numbered 456, and that together they held $1.92 trillion in assets. Now that's a threefold increase in the assets that these two categories held in 2012, when there were 333 mutual funds in variable annuities with $641 billion in assets considering ESG factors. So we're seeing that increase, threefold increase from $641 billion to 1.92 trillion. And we're seeing that growth, across all sorts of categories. Similarly, if you look at the fifth row, you'll see that the private equity and other alternative investment funds considering ESG factors now stand at 336 with $224 billion in assets, and that's up from 301 funds in 2012 with $132 billion in assets. So a near doubling of the assets by these alternative funds. Another interesting product or another interesting category is that other pooled products where the $2.15 trillion in assets is actually increased 9 times over what we found in 2012. This is something of a miscellaneous category. It includes funds such as privately managed nonprofit trusts, collective investment trusts, and other pooled investment vehicles that are generally managed for specific types of investors, such as religious organizations or labor unions. So basically, we're seeing, across the board, all sorts of different investment vehicles, this growth in the funds and the assets of the funds that are considering ESG factors. Some of the interesting detail that's not shown in this table is the growth in attention to particular ESG issues. So from 2012 to 2014, the investment vehicles that consider climate change and carbon-related issues grew from 280 with $134 billion in assets to 325 vehicles with $276 billion in assets. So in other words, we've seen a doubling in 2 years of the assets of investment vehicles that disclose that they consider climate change and climate risk in putting together their portfolios. On another issue, the investment vehicles that restrict holdings in weapons manufacturers grew from 248 with $156 billion in assets to 291 with $590 billion in assets. So that's a nearly 4-fold increase in the assets of investment vehicles that consider and screen on weapons manufacturers. A major driver in this growth, sadly, was the fatal shooting of 20 students and teachers by a single mentally ill gunman at a U.S. elementary school in December 2012. This caused a number of city pension funds to divest or explore divestment from gun. And we can go to slide 4. Thank you. Up until now, we've been discussing the growth in ESG incorporation practices and assets from 2012 to 2014. As Giuseppe mentioned in his introductory remarks, another important aspect of responsible investing around the world, and certainly in the United States, is shareholder advocacy. And in the U.S. market, we measure shareholder advocacy perhaps a little more narrowly than some of our partner SIFs and the Global Sustainable Investment Alliance. In the U.S. market, it's relatively easy to file shareholder resolutions to be included in publicly traded companies' proxy statements. So that is what we measure. It's fairly easy. It's a fairly public process. You know, and from a research perspective, it's fairly easy to confirm that the resolutions were filed, who's filing them, the assets they hold. We know that increasingly institutional shareholders and money managers are engaging in private dialogue with the companies in their portfolios. That's a little harder for us to measure. We do ask about it in the survey, but we don't officially count it in our overall number of the dollar value of sustainable and responsible. Well, to 2,000 investors, they represented $1.7 trillion in assets, and they filed hundreds of resolutions at portfolio companies on a range of environmental, social, and governance issues. And through these efforts, investors have persuaded hundreds of companies to exercise better oversight of their political spending and lobbying, to disclose and reduce their greenhouse gas emissions, and to strengthen their fair employment policies. And as you'll see from the chart, when we count the numbers of shareholder proponents, the preponderance are based with religious organizations, but these often tend to be somewhat smaller investors in terms of the assets they control, but they often join in alliances with SRI investment firms, with foundations, and with public pension funds. If we look at the next slide. In 2000, to specify the percentage of assets under management that they consider to be involved in strategies of impact investing. Here we go. We use the definition that our fellow members of the Global Sustainable Investment Alliance use. We refer to targeted investments typically made in private markets aimed at solving social or environmental problems. In response, 86 domestic asset managers and institutional investors identified themselves as using strategies of impact investing at the beginning of 2014. And together they $0.8 billion in combined assets. More than half of those respondents, 52%, were money managers, and they deployed $29 billion in impact investing strategies. Philanthropic foundations were the most commonly identified impact investors. Faith-based investors also reported a higher level of assets using impact investing strategies. So the faith-based investors collectively controlled about $1.3 billion in assets versus the $795 billion, excuse me, $795 million cited by the foundations. Educational institutions, family offices, healthcare institutions, public funds, and other nonprofit organizations were among the other kinds of institutional investors that identified themselves as using impact investing strategies. And although the terminology in the United States, just goes back maybe several years, the practice is not. Numerous sustainable and responsible investors have long pursued social and environmental outcomes across asset classes by investing in areas such as microfinance, sustainable community development, clean technology, and other environmental solutions. And as we've discussed, looking at shareholder advocacy, and investors in listed equity have also pursued social and environmental impact, often by engaging with publicly traded companies in a variety of ways. So little assets in private markets, but not necessarily. So there's kind of a range of viewpoints of what impact investing encompasses. We also report in the U.S. We also look at assets of community development banks and credit unions that are held by retail investors. So our overall total that we put into impact investing would include those community investing assets, which brings us up to about $69 billion overall. So that is some of the highlights from the report on U.S. sustainable responsible impact investing trends in 2014, and I look forward to taking questions from all of you. Thank you.
Thank you, Meg, and thank you, Francois, for your presentations. They that gave a lot of insights. Just want to remind everybody you are able to ask questions. We have like 10 minutes left. If you list your questions on the box to the right of your screen, we'll bring them forward. Just to kick off, a question to Francois. Francois, Meg has explained about the drivers in the US for sustainability. What are the drivers in Europe?
So in terms of driver, we don't really survey this, but we have a mini survey, but it's not as detailed as in the US. I think, to me, there's a key driver. There are several of them, but the key driver is the growing realization that taking ESG matters into account is just better risk management, and I use risk with a broad definition. It's also a way to manage your reputational risk. And so, for example, there are quite a few large asset owners who are adopting ESG practices as a way precisely to manage this reputational risk, as well as to enhance the risk-return profile of their portfolio. So I think it's a key one. Another driver is, of course, the legislative driver, and that's a very strong signal here, a strong development that we see in Europe. SRI is under the spotlight more and more. Policymakers, at least at the EU level, are interested in harnessing the potential of SRI. In a context where we're trying to inject more capital into tangible, productive assets into the real economy in the search for growth. And so SRI could be one element of answer for some policymakers at least. And so there are quite a few initiatives at the European level, such as the revision of the Shareholder Rights Directive, that have the potential to increase the ESG or SRI market. And just to name another one, in France, there has been recently the adoption as part of the law on the on the ecological transition. An Article 173 was mandating basically asset owner to report on their climate impact, of course in the run-up to COP21. But I think these are legislative developments that really have the potential to increase the awareness around those issues and incentivize further adoption of ESG practices.
Great, thank you, Francois. Very clear. And regulation also this morning was mentioned as a key driver in Asia, for instance. Meg, can you comment on that from a US perspective? Does legislation and regulation play a role over there? And is that role increasing?
We sometimes see regulation at the state level. Many of the state pension funds are operating under directives as a result of the state legislatures. They may be prohibited from investing in countries that are designated as sponsoring terrorism, for instance. We also, one of the regulatory arenas we're watching is there is a federal law that governs private sector pension funds. It's called the Employee Retirement Income Security Act, or ERISA for short. And the bulletins that have been issued by the Department of Labor to provide fiduciaries, the language is a little issues, and the language almost restrains them the issues.
Okay, Meg, I'm not sure if the quality of the line is correct. The quality of the connection.
A number of investors in the United States are, items, and so. Hello, can you hear me?
Meg, the quality of the connection is not terrible as it seems. So as you can.
Okay. Can you hear me now?
Yes, we can.
Okay. So I'm not quite sure where I was when the sound got cut off, but just very quickly, we are watching this regulation for the federal law that governs private sector retirement plans, and we're hoping that the language and the guidance on the consideration of.
Okay, thank you, Meg. Let's go to a question that has just came in.
Issues will be updated. Permit issues.
Okay, let's go into a question that just came in. The question is, what would you say to people who state that adding ESG criteria lowers performance? And what could be good strategies to add ESG without harming performance or even increasing it? Francois, can you start the question?
Yeah, it's true that we hear sometimes that, I wouldn't say ESG criteria, but SRI lowers performance. I mean, it's a traditional, classic argument that is sometimes advanced, and it's also, reflects the whole debate around fiduciary duty, etc. But the answer is very simple. In fact, there is no academic study, there's just no academic study or any meta-study that shows that it clearly detracts performance. It depends what you call ESG criteria, if you're talking only about exclusion or, broadly speaking, SRI strategies. There have been a couple of meta-studies by Mercer, by AP7 and some others in Europe, and what they show is that there is no clear signal that SRI strategies outperform traditional strategy, neither is there any signal that they underperform, in fact. So there's just, the answer is probably that we don't have any academic proof, and there's probably not enough historical depth really to prove that SRI strategy in aggregate, of course, it's always in aggregate, are able to outperform. But intuitively speaking, if you take a holistic view at your risk management, so if you manage not only financial but also pre-financial or ESG risks, over the long term, you should be able to outperform. Now, there are good SRI managers and bad SRI managers, as there are good traditional managers and bad traditional managers. That's the only answer I can give here.
Great, thank you, Francois. Just another question to you.
Yes,
out of the two presentations,
Meg,
go ahead, Meg.
Yes, I would just add to what Francois has said that there's, just an increasing number of studies, and I would, direct the questionnaire to resources like the United Nations Environmental Program Finance Initiative, which has commissioned a number of studies on this issue. And there's a number of meta-studies out that have kind of gathered the literature, academic literature on SRI performance, and I think it's generally neutral to positive results with regard to that question.
Okay, thanks, Meg. What I always have been taught is that the least you can say that the SRI funds do not perform worse than, let's say, old-fashioned or classical funds. Last question because I look at the time. Some questions have been asked that are either pretty detailed, so I would encourage the speakers to sort it out with the person who asked the question after the meeting, or very generic, and they have been treated here. I have one more question about retail market. When you compare the situation in the US to that in Europe, you'll see that the retail market is less apparent in Europe, and I wonder, Francois, what's the reason, or what can we learn from the US?
I think it depends. I can't remember this from Meg. What you count under retail. If there is a defined contribution effect in the US or not. As you know, the defined contribution market is much more developed in the US than in Europe. That could be an element of answer. And I think in aggregate, it's true that the European retail market is weak compared to as a tiny market share compared to the institutional market. That said, if you look at individual markets, for example, France, Switzerland, Belgium, maybe some others, I think Germany is also in that situation. In relative terms, the retail market can be quite interesting. In France, I think it's about 30% of the core SRI assets. And that's due to strong presence within employee saving schemes and life insurance products, which are very popular in France. In Belgium, it's due to structured products that are sold as responsible structured products with, say, the underlying being selected according to ESG criteria, for example. And in Switzerland, it's of course tied to the impact investing approach, and more generally, the more appetite by high net worth individuals to buy this kind of strategies. So that's what I could say. I don't know why otherwise it's weaker than in the US. It's probably due to some structural market reason.
Okay, Meg, can you add anything about it from your point of view in the US? Talking about the US, the relative importance of the retail market in the US.
Yes, well, I know that when we survey money managers and do research on money managers for the U.S. Trends report, we try to specify what portion of the assets they manage are for the retail market, and that's usually specified. If you look at mutual funds, for instance, identify the retail assets versus the institutional assets. And I think probably it has to do with the structure of retirement savings in the United States, that a number of individual investors have defined contribution plans, and so they are investing in mutual funds for their retirement. And I think that's that may be more established in the United States compared with other regions. So it may be something structural, as Francois says.
Okay, great. Thank you, Meg, for us, and thank you, Francois Passon, for your presentations and the answers you gave to all the questions. Thanks, of course, for everybody who joined us for this webinar. As I said before, this webinar is recorded and can be found later on through the GSIA website. You'll see the link on your screen at this moment in time. Also, you will find there the global report that we referred to in the beginning. And if you have any additional comments, suggestions, or questions, please don't hesitate to let us know. You can contact Imre Fenneka at the email address provided on your screen. So with that, I end this seminar. Thanks again, everybody, for participating, and I wish you all a great rest of this day. Take care. Bye-bye.
Thank you all. Bye.
Thank you.